We have Heather Dreves, who is the Director of Funding at Secured Investment Corp. And you saw me, I had to read it because it's kind of a mouthful. But Heather, I really appreciate your time. We're going to be talking about something that's relatively newer to my listeners. You know, we've talked about self-directed IRAs and being infinite banking and, you know, a variety of other financial related topics. However, this is going to be the first one that I can recall that we are talking about investing in this nature. So I really appreciate your time. But before we kick things off, I'm going to send everybody to your website because I know there's a lot of information and a lot of resources there. So head over to securedinvestmentcorp.com for more information. And I'll make sure to have that link in the show notes. But Heather, was there any place else you'd like them to send them?
No, that's going to be their best source of information. And, you know, once the listeners get to that website, they can get a lot of content and information on the website, but then they also have the ability to schedule an appointment to talk with myself or someone from my team if they'd like to explore options further.
So we're going to be chatting about real estate investing funds. And we probably I warned you that a lot of people that listen to my show are relatively new to real estate investing, and they probably may not even know what that is. So let's start off with defining what a real estate investing fund actually is.
Yeah, no, I think that's a great place to start. So, you know, it's interesting. Our company historically got started with active real estate investors. So people that are actually buying real estate assets, whether they're fixing and flipping or holding them as rentals. And what we found was there was a lot of people out there that, you know, for whatever reason, maybe they didn't have enough money to buy a piece of real estate or they didn't have the time, but they liked the asset class of investing in something that was backed by residential real estate. So we naturally progressed into a fund management team. And this is essentially a real estate fund where our fund members are in a pool with other investors, and we essentially manage the fund for them on their behalf. And this fund's assets are all composed of residential real estate assets. So we're not a commercial lender, we're not a self-storage lender, we're not doing syndication. It's really just a passive way to be able to invest in real estate and reap the benefits of it, but not invest as much money as you might need, not invest your time. You know, essentially we are managing it for them. So it's really an alternative asset class, you know, outside of your more traditional sources like the stock market and things like that. But again, we focus on anything that's single family up to 4 units. That is we stay in our lane. We're a residential real estate fund.
Sure. So, you know, you mentioned syndication. It kind of sounds a little like syndication, and I can see how people might think that's the case, but can you kind of break down, you mentioned you're doing single family homes. I'm sure there's other people who run funds that do multifamily and a variety of other things. But can you kind of break down exactly how it's a little different? Because it almost sounds like it's almost like the stock market to a certain extent.
Well, I think the biggest thing that is different between our fund and something that somebody would consider more of a syndication fund is, in my opinion, in my eyes, a syndication is something where you benefit long-term, right? You invest in a syndication. Typically, you agree to be paying a preferred or not necessarily a guaranteed rate, but a preferred rate. But the upside to an investor in the syndication is when that property is sold or refinanced. You share in those profits, and that could be 5 years down the road. Mm-hmm. We focus on the residential space, and so our strategy is cash flow. So we take 75% of our fund balance and we create profit for the fund and the fund members through lending that money out. So we will lend money to other real estate investors that are looking for short-term loans. So the fund makes profit off things like interest payments, original points. We take the other 25% of the fund balance and we invest that in real estate assets, mainly with the strategy to fix and flip. So again, it's a quick turn on the money. So investors that are looking for cash flow investments or very fast growth mode investments, our fund is a good option for that because all earnings are paid out on a monthly basis. And so depending upon what an investor's strategy is, I deal with people that are retiring, selling their business, maybe they were self-employed and they're looking to replace that income stream. The cash flow side of it's very nice. They don't have to wait 5 years to see the profits. But then also for your younger folks, I tell everybody, especially, I wish I would have done this when I was 20 years old. I wish I would have started a self-directed IRA because that is a great tax deferred strategy. And with our fund, you can actually put it in growth mode so you can reinvest your earnings and just compound your earnings in that sense. So that's the biggest difference. I think you see immediate earnings with our fund opposed to the long-term strategy. And there's nothing wrong with that. It's just really dependent upon what the investor's looking for.
So your primary purpose, you said 75% of it goes to lending to other real estate investors what are they actively doing then? Fix and flipping themselves, or what is that? How is that money typically used?
Historically, it's been people fixing and flipping, but we all know markets are shifting, right? There's a lot of opportunity right now in the markets for rentals. So we have seen, that kind of shift a little bit. Some of our borrowers are coming to us looking to buy properties to turn into rentals, then they'll exit our loans with a longer term funding option. But again, our money is usually used to acquire the property and maybe rehab it a little bit. So they're short term in nature, usually a 12-month loan.
Sure. So it's kind of like that first part of the BRRRR strategy, right? Buy, rehab, refinance. Yep. So you're kind of filling that first R there.
Yep, absolutely. And the nice thing with that is, as far as from a risk assessment for the fund, when you're dealing with short-term lending, there's not as much risk in market shifting that quick, right? I mean, typically, if you're lending on something, it's pretty unlikely that in 12 months you're going to see the markets drop, lower than what you lent at. The other thing is we only play in the affordable housing market. So we don't lend on jumbo high-end homes. These are first-time home buyer homes. And we don't lend more than a 70% loan to value. So our loans are very low risk in nature because there's such an equity play in them, which bodes well for our funds. Our fund performance of those types of assets does very well because there's such a big equity position. Our borrowers are very motivated to make their payments, pay us off, and use us for other funding, sources.
So do you typically provide the funding for the purchase and some of the rehab as well, or is it just for the purchase? How does that look, the distributions?
Both. So we will lend up to 90% of the purchase price, meaning they need to bring in 10% of that purchase price. And then we will lend 100% of rehab funds as long as those two numbers combined don't exceed 70% loan to value. So the borrower would have to bring in closing costs, 10% of the purchase price, and anything that would exceed that. So they're very low risk.
What kind of details do they have to provide you then to qualify for that? Like, I'm sure that there has to be at least a business plan or a plan of attack associated with that fix and flip so that you have some insight as to what it's going to cost and what they plan to do. And then you probably do some due diligence yourself.
Yeah, we have quite a checklist for underwriting. People always ask us if we're a hard money lender. I think we're really more of a private money lender because we do have a pretty due diligence process. A couple things that we do is we only lend to entities because these need to be business purpose only loans. So we're not wanting to lend to someone that's living in the house. And the reason for that is in the event of a foreclosure or default, it's harder to, foreclose on those types of properties where it's owner occupied. So an entity in good standing, they need to have a contractor's bid so that we can see exactly what they're doing to the property to improve the value of it. And then on the other side of that, we also hold back all rehab funds. So our borrowers have to come to us, say, hey, I've gotten the electrical done. We'll send an inspector out there, a third party that confirms whether the work's been done, and then we will reimburse them for those monies. But outside of that, the strengths of the borrower are important to us. I mean, we want to make sure they're, in good standing with their credit. They can have, but we want to know that if there's been any issues, those have been resolved. They need to be filing their taxes and then providing financial bank statements, to show us that they can service the debt, and actually complete the rehab if need be. So I tell people it's logic-based lending. Does the deal make sense? Is the value in the property, in the event that we have to take it back? And are we putting this borrower in a good position where they're going to be successful, finish the project, make themselves some money, and the goal is that they come back and borrow from us again. So it needs to be a win on both sides.
Sure. Are you limited to the area in the country that you're in then to provide these type of resources?
We are probably in every state but 4 states. So we're just about nationwide, but there are a handful of them, Nevada being one of them. We're not lending in Nevada. There's 4 of them that we are not in.
Sure.
But for the most part, nationwide.
Okay. Well, if you want to see if this is a good fit for you on the investment side, or maybe even the lending side, maybe head over to securedinvestmentcorp.com. And it does lead me to my next question on the Secured Investment Corp. You're pretty blunt in the name of your company. What other ways is the investment secured?
Well, so when people invest in the fund, and I think, the lending aspect of it that I just spoke about is really the active real estate investors. But for those folks that are, on this podcast and they're not necessarily wanting to, jump in with both feet and take down a property, there's opportunity to invest in our funds. And we have a fund that's pretty unique because it's open to everybody. Most real estate funds historically have been only open to high net worth accredited investors, which we have a fund like that. We've had it for 10 years, but we felt like we were doing a huge disservice to all of our clients and the general public that want to invest and create wealth for themselves, but couldn't do that because of the SEC rules. So we now have a real estate fund where they can invest as little as $1,000 and just get started there. That fund is great for old 401k accounts that people haven't rolled over. Get those with a self-directed custodian, get that money working for you. And I have a lot of people that'll say, I've only got, $3,000. How could I possibly get started? You can get started. That's how you create wealth. You have to start somewhere. And so that fund is a great option for that. Average yields on that fund are 8 to 10% annualized. I don't know if you pulled the savings accounts earnings recently, but I was terrified last week when I pulled a list of that at how many savings accounts are earning less than 1%. So 8 to 10 on small balances is a great opportunity. So that's how our fund is secured. All those loans that we originate, the fund owns. We don't own those. We manage it. All those properties that we buy are secured with that fund. And those are all tangible assets. It's not like a stock account that can fluctuate and, may dip lower than what the value was that you bought it at. These are tangible assets. Again, they're all residential real estate. And people can invest with as little as $1,000. So it's a great opportunity and a very secured fund.
Yeah, that's interesting. So how liquid is that if somebody needed to access that?
So that's a really good question. The tie-up period is a year. So when people invest into the fund, they need to commit to staying in for 12 months, and then they can start to divest out after that. So it's fairly liquid. We're turning that money all the time. There's short-term notes. The real estate is being purchased and sold quickly. So it's fairly liquid, but they do have to commit to 12 months.
Sure. So let's talk about the history of this. And I typically start these type of questions off early in the conversation, but it kind of fits naturally here. Like, how long has your company been in business, and how did you find this niche?
Yeah, so we actually as a company got started as a real estate education company. So the other side of our company puts on events and we teach people how to buy and sell real estate, really. So we were an education company that started over 20 years ago. And what we found was this was amazing. People were finding great deals, but there was a lack of funding for it, which naturally progressed into our private lending side of it. And what we found was we had a lot of investors that wanted to fund these deals, but it's a clunky process. As a borrower, when you're ready to close and you got a hot deal, you got to close right away, right? And so what we found was, we had the people that were looking for the money to borrow for their transactions, and we had the people that wanted to lend the money, and we were trying to partner them up, and we did that. But we found 10 years ago that opening a fund was a much easier process, and people liked it better. People don't, investors that invest in this kind of asset want to be retired and they want to get their earnings and they don't want to deal with headaches. Otherwise they'd be a real estate investor, And so the funds were a nice progression for us. So we've been managing funds for 10 years. None of our funds have ever lost money. They're all regulated by the SEC. We're in good standing. They've been yielding anywhere from 8 to 11% for the last 10 years. So they've done very well.
Oh, that sounds great. So you mentioned, the other part of it is the 25% of this fund is active fix and flipping yourself. Like, how do you manage that, and where do you typically fix and flip those properties?
So we're located in Coeur d'Alene, Idaho. For those of you folks that read the Wall Street Journal, it's like the hottest market right now. We're right next to Spokane, Washington. And so we only actively buy those types of real estate assets in our local market. We have a acquisition team that goes out and finds those deals for us. We have our own contracting crew. We're a licensed and bonded contractor. And so again, we only focus on real estate assets locally in our market. So Coeur d'Alene, Idaho, specifically in Spokane, Washington, is where we concentrate on those types of assets, because we're not interested in rehabbing a house 9 states over. That's not what we teach our clients to do, and it's not what we practice as fund managers. So those are all local assets.
Why did you make that decision to split it up like that? That you're doing some of this work yourself and then helping other investors?
Because it diversifies our portfolio. In the event that our origination team is slower 1 month, as a fund management team, we can kick it up with our assets that are actual real estate assets, and vice versa. We live in an area that has really hard winters, and we don't sell as many properties through the winters, which means we can always ramp up the other side of it. And it's helped us have just a really consistent return. We don't want to have high quarters where we're paying out this much, and then, during November, December, January, the returns aren't as good. And so we wanted to diversify. And then the second reason is really just to help us have consistent returns and be able to adjust and pivot as a fund management team.
Sure. So how many deals do you typically have fix and flipping yourself at a given moment?
I'd say right now, I'd say on average, we'll have 10 real estate properties on the market for sale, and we'll have 10 probably in some form of production. Again, we're not rehabbing high-end homes. Typically we're going in, making sure electrical's up to code, plumbing and things of that nature. And then a lot of it's cosmetic. So we'll typically, the average time to actually get it, once we get into a house and have it back on the market, it's about 3 to 4 weeks. I'd say average time that we're in deals is about two months, maybe 3 at the most.
Sure. So, let's go back to the investment side of things. If somebody is looking at something like this, after listening to a podcast like this, I think a lot of people start to get an idea that real estate investing isn't easy. I mean, it's something that is a very active job. You're essentially creating yourself a job. If somebody was interested in a fund like yours, or yours for that matter, what type of questions should they be asking to make sure it's a good business, a good fit?
That's a really good question. So we actually just got involved with a company called Dreves. And basically what Dreves does is they are a third-party company that is out there making sure that fund operators like ourselves are acting in good faith and are compliant. Because I'm going to tell people right now, there's a lot of really bad fund managers out there, and you need to be skeptical. You need to ask a lot of questions. Ask if they're an audited fund. Our funds are fully audited by an outside auditing firm on a yearly basis. That means a third party comes in, looks at our bank statements, looks at our books, makes sure that we're being compliant. But what Dreves does is they actually do that on a quarterly basis. And if people go to their website at Verivest, Verivest, they'll see us on there. We are compliant and approved with them. And Verivest has this huge initiative to weed out bad fund operators, because they've been in the industry a long time. And I think fund managers and companies get a bad rap out there because, again, there's a lot of really bad ones. But I would encourage people, when they're doing their due diligence on companies and funds like ours, make sure they're audited funds, make sure they're regulated and registered with the Securities and Exchange Commission. That's really important, because those are outside eyes watching us, making sure that we are doing things as we should be. It's important. And, we have full transparent fund reports. We can help supply people And if they get a hold of me, we can talk about that and I can supply them with that information because I think it's important as a fund operator to be really transparent with your fund members.
That kind of does lead me to my next question regarding the reports. Like, what kind of insights does the investor have into what's going on? Whether is there an online portal? Do you receive paper reports?
Yep.
How does that all look?
We have an online portal where when people invest into our fund, they set up their username, and that's I tell them it's our lifeline. They can always call us. We will always pick up the phone here. I think that's a big difference with us. But they also have online access. So that's especially important as people are setting up their accounts. Like I said, they can choose to have their earnings paid out, or they can choose to have their earnings reinvested. And I think when people are doing things like reinvesting, that's where there's a lot of room for error and fund managers to kind of fudge because people aren't expecting checks, right? So your online platform is where you can see those earnings being rolled back into your account. You can see exactly what your yield was on a monthly basis. Obviously, if you're getting checks, you see those checks coming to you or your IRA custodian. But yes, it's all online. We actually have to file our reports with the Securities and Exchange every quarter. So those are public information, and that's all of our financials. It's all on the SEC's website. And then we send out quarterly information to our fund members, just keeping them, privileged of what's going on, what we see in the marketplace, what our activity was like the quarter before. So we're really transparent with all of that.
Sure. So, talking about transparency, like, do you typically have people even coming and checking out like some of your personal fix and flipping and those type of activities there?
Yeah, we love when our fund members or any client for that matter comes and stops by our office. A lot of our projects are located around where we physically have our corporate office. But yeah, people are always open to, and we're open to them, coming and look at those, and we encourage that. And a lot of our clients do come into town. I just had a couple last week stop by unannounced, and I think they purposely did it, and we loved it. We want to show them around, and we want to introduce them to the faces that they talk to on the phone when they have questions about their accounts and things like that. So we do encourage that. Absolutely.
So, you have a lot of moving parts going on here. How do you keep track of it? How big is your staff?
So we have about 100 employees. There are 3 fund managers. I am one, and then there are 2 others. Our CFO is our second fund manager, and then our third fund manager is our CEO. I have a team that works with me that raises capital. So that's a team of 4 of us. We have a full accounting team. These funds require a lot of accounting responsibility. So we have a accounting department where a portion of them are dedicated to the funds. We have an underwriting staff. We also service all those loans. So all those loans that we originate, we actually collect all the payments. So we have a servicing department of 4 individuals. We have a legal and compliance team. Yeah, we're pretty robust. And then we meet multiple times a week as a team on different things, whether it's with our property team, our property acquisitions, we meet once a week on that. We meet with our servicing department on any problem accounts on a bi-weekly basis. We meet with our origination team twice a week for any deals that are of question that maybe the underwriter has questions about. So we're in very close quarters, and we all work very closely together as a team. It takes a tribe to manage these funds.
Yeah, I bet. And to that extent, I mean, you kind of have an extension of your team when you lend that money out. Like, how involved do you sometimes have to get with some of these people who are trying to fix and flip, for example, with the money you lend?
That's actually a funny question because we just had a meeting about that today. So we meet on a bi-weekly basis on what we call our draw team. So these are the people where the borrowers will call them up, say, hey, we're ready for our draw. And so if there's any challenges, we want to be right there. We want to pulse on what's going on, because then if they do have a problem, we can at least help them and coach them rather than not hearing about it for 10 months. And then we're realizing, oh, shoot, these people are having a huge problem. We would rather know right at the onset of the problem so we can help them. It's not often. Most of our borrowers are very sophisticated, But, challenges that come up are things like, hey, I had a flaky contractor, he took off. Okay, great. Let's get you back on track. Or there was a lot more work, once we started tearing up walls, there was electrical issues, so we would rather help them be successful than just take their properties back. We don't want their properties. We want them to pay. We want them to sell the property or refinance and pay us back. And so that's really the approach that we take, is let's help them be successful rather than back them in a corner. And it's not often. Most of our borrowers are very qualified, but as an active real estate investor, nothing goes as planned. Plan for the unexpected, because it's going to happen. But we would hope that they understand that we're a resource, to help them, coach them through those challenges.
Well, I'd have to think that you're kind of in a unique situation. I mean, you came from a training in real estate arm too, so you do have some of that bench to go to, probably to help with some of that type of thing.
We've had students that we've called up, hey, I got a guy with a problem in Missouri. Could you go check it out? And it is not uncommon to, have that more sophisticated borrower that has experience help someone that's a little less experienced and help them get through their challenges. It happens all the time, when we've had challenges. So our database, being a nationwide education company and a nationwide lender, means we are just broad. We have tons of, I can go in my database and pull up 200 people out of Missouri that could potentially help someone with a challenge. So that has been very helpful from a portfolio management perspective.
Sure. So just to remind everybody again, head over to securedinvestmentcorp.com for a lot more details and see if this is a good fit for you. Maybe is that piece that you might be missing with your retirement account. Mm-hmm. Before I let you go, I'm going to wrap this up here now. We're closing in on our time, but okay. Heather, is there a question you wished I would have asked you here tonight?
I don't think so. I think we covered so much. I originally thought that my message was really just going to be about the funds, but I also want to make sure that people understand if they're more active and they're looking for funding for their projects, we can help them with that. And I guess probably if there was a question, what our motto here is. And I think that's something important to mention. We have a motto and we call it the circle of wealth. And we say that everybody's in a different place in the circle, right? Maybe you are brand new to real estate investing and you come into our circle through the education, or you're more active and you're buying deals, but you need funding. And then there's the passive side that I deal more with. But we would hope that everybody comes into that circle of wealth at some place. And eventually our goal is for everybody to become a passive investor once they start creating wealth for themselves and their family and start growing that side of their portfolio, because I think that's important too. We encourage having multiple streams of income. So, that would probably be the one thing that I wish you would have asked, but now we know. Circle of wealth. Circle of wealth.
Well, in a roundabout way, we got there, right?
Yep.
So, well, Heather, it was great chatting with you. I hope you consider coming back on again. We can talk more in detail on a couple other thoughts that came to mind now that we've chatted. But I really appreciate your time.
Yeah, absolutely. Thank you. And for everyone that's interested or would like more information, they can visit our website at securedinvestmentcorp.com.